to introduce myself also. I'm Balram Vichidi, Chartered Accountant, and I've been in the industry for the last 20 years, worked with various big four firms like PwC, KPMG, and Deloitte. So now currently I'm on practice. Thin capitalization and UAE interest limitation approach. So this is what we're going to talk about during the next 45 to 50 minutes. The story behind thin capitalization and its adoption in UAE. Key issues in thin capitalization highlighted in OECD guidelines, and then OECD's approach to tackling this thin capitalization, understanding interest reduction limitations, and then key takeaways on thin capitalization norms in UAE, and then other practical considerations that we have. So before we get into this thin capitalization in detail, so the basic thing is about generally whenever any person is starting a company, in UAE especially. So there are no particular norms as such with respect to the capital. There's only minimum capital requirement depending upon the license issuing authority. They fixed what is the capital amount. In mainland, generally DED entities they generally mention 300,000 as a minimum capital. You can still have less than that amount, but generally it is about 300,000. But if you see free zone entities, and there we have different amounts as minimum share capital depending upon the free zone that you are incorporating in. Some of the free zones have got as less as amount of 10,000 dirhams. Somewhere else you can also start a company with 1 million, one dirham also. So there are the various rules that we have in and around the capital amount that we need to maintain. But as we know, so to establish any company, depending upon the activity that we do and depending upon the kind of industry that we are in, the amount of capital requirement will vary. For a small service company, you may have less amount as capital requirement. For a company which is into manufacturing and distribution activities, they may require a huge amount of money as a capital to start the business operation as such. So this being the case, so now let's quickly get into what is it and then what are we going to talk about. So the companies which have got situations where they have financed more amount or debt is more amount than equity. So this is going to be applicable for most of those companies. And as we know, when we compute the corporate taxes, the base is going to be a profit, and then we make some adjustments to arrive to the taxable income. So as part of this, so we also consider interest as one of the expenditure, right? So in a company where your interest portion is much higher, then obviously your profits are going to be lower in that company, and whereby you pay less amount of tax. So in a way, so the interest expenditure is going to determine what is the amount of taxable income that you will have and how much amount of tax you will be paying it. So obviously the tax authorities will be interested in looking at the interest amount and whatever interest amount that you charged, is it right amount or not? So that's what the authority is interested in looking at, and that's where the thin capitalization rules have been considered or brought in. Not only this, and the companies which are part of the group M&E groups rather, and in the process of charging this interest and taking loans from group companies from one country to another, so they're trying to shift the profits from a country where the taxes are higher to a country where the taxes are lower, depending upon their location of the entities in the group. So obviously, if you are paying tax, if you are paying interest from one country to another, it is higher. If you're paying tax, if you're paying interest to a company of your group, which is situated in another country where the tax rate is lower. So in this process, you're trying to shift your profit, correct, from the country where the tax rate is higher to a country where the tax rate is lower. So in order to curtail these kind of arrangements, the OECD has released those BEPS action points and then initiatives. So number 4 from those BEPS action point talks about this particular arrangement to curtail that particular arrangement. So in line with that particular BEPS action initiative, UAE also has brought in the rule with respect to this thin capitalization. So UAE is under Article 30 of the corporate tax law. They have introduced general interest deduction limitation rule. So we'll talk about this rule in detail in the following slides. Not only that, the UAE has also introduced specific interest deduction rule also. So this is specifically for the loans that have been taken within the group entities of between the related parties. So we'll also look at this particular specific rule, which is specific interest reduction rule also. In addition to these two particular articles, Ministry has released the Ministerial Decision number 126, talking more in detail about these particular articles and a little bit more guidance on that. So this is the background, and this is what we are with respect to UAE corporate tax rules related things on interest and in capitalization rules. Further, the key issues with respect to this. So the OECD has brought in and talked about this. I mean, we touched base on this in the previous slide also, but how these arrangements have been done is that groups placing higher level of third-party debts in high tax countries, and they borrow the funds from third parties in the countries where the tax rate is higher and try to move these funds to another country or to another company where which is part of the same group and where the tax rate is lower. So in the country where they have taken the loans, they are paying high amount of interest rate, whereby the profit is being reduced by that amount, and then they are paying less rate or less tax. And the funds have been moved to another country, another company where the tax rate is lower. So there it has been enjoyed since the tax impact is less there. So in this process, they are trying to shift the profit as well as take the tax advantage by following these practices. Not only this, the other thing is that within the group, if you are multinational entities, M&A group, so within the group also the funds have been moved or loans have been given by one company from the country where the tax rates are higher to another company where the tax rates are lower. In this process also the tax advantage has been taken. So the similar thing what we have mentioned or spoken in the previous slide, same thing has been done. The third scenario is that groups using third party or intra-group financing to fund the generation of tax exempt income. So you're using these funds by taking loans from third parties or intra-group financing and using those funds to generate tax exempt income in other countries. So in this process, you are getting the benefit of tax by paying interest, by showing that interest amount. But at the same time, ultimately, where the funds have been used, there the income generated is not taxed. So this process also is being followed by many MNEs. So OECD came up with these rules in order to curtail this kind of arrangements. So let's quickly look at one illustration just to understand the concept more. Let's say you have company A in one country, and company B in another country. And company A is giving a loan of 1,000 dirhams to company B with an interest rate of 10% annually. Now let's look at the statistics of this company A and B. The corporate tax rate of company A is 15% and company B is 35%. And last column, you can see the group total overall results. So the operating profit of company A is nil and company B is 150. And interest income from company B is 100 dirhams. Out of this debt or the loan that is given, so company A is able to generate 100 dirhams interest, which is 10% on 1,000 dirhams. And profit before interest and tax. So in company A it is 100 and company B it is 150 dirhams. Interest paid to third parties. So company A does not take any loan from outsiders. But company B has also taken a loan from outsiders, and then interest on that is about 130 dirhams. Now interest paid to company A. So as we have seen, company A has given loan to company B and interest on that is 100 dirhams. So obviously company B has paid 100 dirhams as interest to company A. So now if you look at this profit before tax in company A is 100 dirhams, which is interest amount that is received from company B. And in the hands of company B, it is a loss of 80 dirhams because we have 150 dirhams profit and then interest paid is 130 as well as 100, and whereby we end up in having a loss of 80 dirhams. At group level, you have a net profit of 20 dirhams after knocking off these two or adjusting these two. So by calculating when we compute the tax amount for company A, since we have corporate tax rate of 15%, so on profit before tax, we have 100. So 15% on 100 is coming to 15 dirhams. So corporate tax in the hands of company A is going to be 15 dirhams. And in company B, since we have a loss of 80 dirhams and corporate tax rate is 35%, so we can just say that 28 dirhams is going to be your loss that can be adjusted, or that tax rate, a tax amount that you can get as a adjustable amount. So net impact on group level is 13 dirhams. So profit after tax is now, if you see 100 minus 15 in company A is going to be 85. In company B, it is going to be 52. So when we have loan scenario and when we see these two companies together at group level, we're able to see a net profit after tax is 33 dirhams and corporate tax amount of 13 negative. And now if you see the same case study, but without having any loan scenario, let's assume that company A is not giving any loan to company B. So if that being the case, what is going to be your impact on your profit? So company A, since they do not have any income, so the tax amount and profit after tax amount is nil. In the hands of company B, since they have profits before interest and tax is about 150, and they have taken loan from third parties and they paid interest of 130 dirhams. So 150 minus 130, so the profit before tax is going to be 20 dirhams. On this, tax is going to be 7 dirhams at 35%. So when we see in these two scenarios, in loan scenario where loan is given by company A to company B, the profit after tax is 33 dirhams. Whereas in second scenario where there is no loan, the profit after tax is 13 dirhams. So in the way of these loans between these related parties, the group is able to save or have an additional profit amount of 20 dirhams. So this is how the group companies, by giving loans between them, they're able to manage the interest amount as well as the net profit amount after taxes. Okay, so with this example, we can understand what is the impact and what is the importance of this interest thin capitalization rules. So how is this OECD is going to handle or tackle this thin capitalization? So they have come up with these three rules around this thin capitalization to handle. One is about fixed ratio rule, other one is about group ratio rule, and then third one is about targeted rules. So there are the three kind of rules that they came up with, so fixed ratio rules. So it's based on the net interest on versus your EBITDA. This is what is called as fixed ratio rule, which means your interest amount as a percentage on your total earnings before interest and tax. So they may give certain amount of a percentage above which it is not allowed to be deducted. This is what we have in case of UAE. They have given 30% as a limit in excess of 12 million dirhams that we will see in the following slides. So this is a fixed ratio rule. So you have a fixed amount of percentage up to which your interest is allowed to be deducted. In excess of that is not allowed to be deducted in that year. So this we will look at the each individual entity or taxable person level. The second scenario, a second rule is about group ratio rule. So here it is more or less similar to your fixed ratio rule, but only thing is that the computation of your percentage of limit is going to be computed for your entire group as a whole group across the world. So for all the entities together for your group across the world will be considered for EBITDA computation as well as interest. So at a group level, what is the rate of your interest on EBITDA coming? And they can have limit on that particular group level ratio. So that is about second scenario. So we have different rate in different countries, but on overall level, how is the ratio coming in? And is the ratio fitting into the limit that they have given or not is what they have come up with. And then third one is about targeted rules. So it is not specific to any particular rule limit or ratio limit, but it could be anything other than these two. They can mention the amount or they can mention something else or some ratio which is not connected to EBITDA and interest. Maybe your debt equity ratio. So if your debt equity ratio is fitting into a particular range, then you can claim interest as expenditure fully. Or if you are going beyond that particular debt equity ratio, then the interest amount that can be claimed can be limited to that particular specified debt equity ratio. Or it can be a specified amount that also can be given. So this third category is about that. Other than these two rules, is generally considered as part of third category. So let's look at the interest limitation approach related pros and cons. As I mentioned in my previous slide, UAE has adopted ratio approach, fixed ratio approach to limit the deduction of interest. So they have given 30% of your interest on EBITDA as a limit, above which is not allowed to be deducted. The only thing is that you can carry forward into next years up to 10 years that we will see in future slides also. Under a fixed ratio rule, interest payments on debt can be deducted up to certain limit, as I mentioned, such as a certain percentage of EBITDA. Any additional interest beyond this limit would not be deductible for tax purposes. Of course, you can have different rules for each of these different based on country. But in UAE, we have 30% and then 10 years as a period to carry forward. So let's look at what are the pros by having this kind of approach. So there's a great deal of certainty to taxpayers. They know clearly as to what amount is going to be allowed as deductible and how it can be claimed and what are the rules around that. And it provides a more rational approach. So you are looking at your size of the organization and depending upon that, the amount is derived. So it is connected to your size of the business. So it is fine. So it is rational approach to look at it. And it is relatively simple to implement and you know what to consider and what not to consider for computation. If you are within that limit and you can claim the entire amount, and if you are exceeding that, you know what amount is allowed to be deducted. And it also reduces the resource cost of tax authorities. Tax authorities need not to spend additional efforts and time to look at this since it is straightforward, so it becomes easy for them also to look at in implementation. And it also decreases the compliance burden on companies as well. So because if the formulas are straightforward, you can easily compute and comply with this, and no complexity is involved, so easy to comply with it. And let's look at the cons of having this ratio approach. So this may not accurately reflect the economic reality. So depending upon the economic reality of the company, and maybe if the company is a startup or the company is high intensive on capital or high incentive on investments, then that particular economic reality is not reflected in this approach. So those companies may have higher amount of interest or higher amount of funds requirement. Whereas if you compute the profit for a startup, if you see, the profit would be lesser, and if you compute the ratio, it would be lesser. Interest paid is much higher in the initial period, but the rate that you compute based on the profit that you derive for startup would be lesser. So whereby you're able to get lesser amount of tax reduction. So that's one thing that we have as a challenge for this ratio approach. And second thing is it can distort the behavior of the group affiliates. So you may try and shift your funds from one entity to another entity within the group in order to get into this benefit, and then it may distort the behavior of the group affiliates. And it may not consider the specific market situations or industries, as I mentioned in my previous discussion also. So it varies, the amount varies from industry to industry. So it is not going to be specific to that industry, and the ratios that are given are general across. So some of the industries may get benefit, some of the industries may lose the benefit and then may suffer this. And it may lead to inconsistent treatment of MNEs compared to the independent companies. So as we've seen, so in the previous slides, the group entities in order to get the benefit may move funds from one country to another country, whereby they try to get the benefit. Whereas the companies which are independent companies not part of MNEs, they will not have any other option but to just compute the rate, and then whether if they are able to take the entire amount as interest reduction, they will do it. If they are not able to claim it, then they will not be able to do it and only take it in future period if it is allowed to do so. So this kind of disparity will be there for independent companies when compared to MNEs. So there is no agreed upon international standard for the formulation of an appropriate ratio in this. So each country can have different rates and ratios. So there's no uniformity as such. So these are the pros and cons of having this approach. Let's look at one more illustration of this ratio approach. Company A in country X is giving a loan to company B in country Y. And the loan amount is about 90 dirhams and the interest rate is 10%. So we can say that the interest amount when we compute this is going to be 9 dirhams for the year. And debt equity ratio, if you see for company A, is 2:1. And if that is what is the the ratio given. So if this is a scenario, how much amount can be taken as deductible amount and how much cannot be taken as deductible amount? So interest on this 90 dirhams is going to be 9 dirhams. If you see debt equity ratio is 2:1, so interest rate, and where the equity amount for that company is going to be 10 dirhams. So if you have 10 dirhams as equity and your debt equity ratio is 2:1, so in which case you are allowed to have debt amount which is equal to 2 times of your equity, which is nothing but 20 dirhams. So you have a capital of 10 dirhams. If you have a debt equity ratio of 2:1, which means you're allowed to take only 2 times of your equity as debt. So which means you're allowed to take only 20 dirhams as loan, whereas you have taken loan of 90 dirhams. So in which case the deductible amount of interest can only be limited to the 20 dirhams related amount, which comes to 2 dirhams, 10% interest rate on 20 dirhams of deductible loan amount. It comes to only 2 dirhams. So which means 7 dirhams of interest is not allowed as deduction. Only 2 dirhams is going to be allowed as deduction. So this is what will be approached or followed if you have any ratio approach of debt equity. So we try to analyze as to what could be the debt equity in general. So this is not based on any specific rules from any authority. These are only general range of debt equity ratio that we have come across when we searched, and there's no proper base for this. We only put them here as a measurement to understand, but this cannot be taken as a standard, right? For different industries, there can be a different debt equity ratio range that you may have. For utilities, you have a higher amount of debt equity ratio. Capital intensive manufacturing, you may have 1 to 2 as debt equity ratios, and so on. Real estate, as we know, it requires a lot of investment, so it has not highly variable amount, and so it cannot be considered as standard one. So now let's look at what is mentioned in the law in UAE with respect to this interest reduction limitation. So as I mentioned in previous slide, so net interest expenditure shall be deductible to the extent of 30% of EBITDA. EBITDA means earnings before interest, tax, depreciation, and amortization. So you calculate interest on your earnings before interest and tax, and if that percentage is 30% or more, then you'll have to look at that. If it is less than that amount, or that 30%, you can take the entire amount as deductible amount. If you have interest which is exceeding this 30% of EBITDA, when I say interest here, it is net interest. What do you mean by net interest? Interest income minus interest expenditure gives you net interest expenditure. So that net interest expenditure, if it is within 30% of EBITDA, it is fine. Whole amount can be shown as expenditure for corporate tax purpose. If it is more than 30% of EBITDA, the excess amount cannot be claimed as interest in this year. But however, you can carry forward this amount to next following year and next year. And then in next year, again, we will see what is the interest amount in that year, net interest amount in that year. So that amount plus the amount that is carried forward and carried over from this year together will be looked at and see is it falling within 30% or not. Accordingly, again, you will take this adjustment. So if you are able to claim full amount in the following year, you will claim it. If not, then you will only claim the full amount of the subsequent year, following year, and the excess amount will be carried over to the next years. So this is how you will be looking at your interest amount. And this limit of 30% and then 10 years is not there for banks and insurance providers, providing companies and national business for conducting businesses. So this limit of 30% and this one is not there. And we also have 12 million dirhams as the amount. So up to 12 million dirhams, generally they allow you to deduct irrespective of this limit. Only excess amount will be considered or looked at for this 30%. And when we talk about the specific interest deduction limit, so first we have talked about the general interest deduction limit. So this is very, very specific to your loans you have taken from related parties. So no deduction shall be allowed for the loans availed from the related parties directly or indirectly in respect of following transactions. A dividend or profit distribution to related parties, if you have taken any loan to pay dividend or distribution of profit of a related party. You are taking from one related party and using those funds for payment of dividend to another related party. So there is no requirement to take that loan as such because you are trying to play around within the group by taking these loans. A redemption, repurchase, reduction, or return of share capital to a related party. Again, same. A capital contribution to a related party. The acquisition of an ownership interest in a person who is or becomes related party following the acquisition. So if you are taking any loans from related parties to use for these purposes, you are not allowed to deduct this amount as expenditure for corporate tax purposes. However, interest expenditure shall be allowed if the taxpayer is able to demonstrate that the main purpose of debt or loan is not to obtain a corporate tax advantage. So if you are able to demonstrate this, that the loans taken are not to take the tax advantage, but genuinely you have a funds requirement and you are taking that and to pay that, and you will definitely repay it later on whenever you have funds availability. If that is the case and if you are able to demonstrate that, then you will be able to show that amount as a deductible amount. So generally you can see that no corporate tax advantage shall be deemed to arise where the related party is subject to corporate tax of at least 9%. So the company from where you're taking the loan, if both are paying 9% interest or more, then it is generally assumed that you can have there's no tax advantage as such. So these are the small illustration that we wanted to show. Illustration 1, SLLC, where the tax rate is 5%, has given a loan to WLLC, and there the tax rate is 9%. And this funds taken or loan taken from SLLC is used for payment of dividends or capital contribution to TLLC. This is also related party. So since you have different tax rates, SLLC has got 5% and WLC has got 9%. So there is no uniformity of tax rate. And the WLC, of course, it is paying interest to SLLC, and where the tax rate is lower. So there's a clear tax advantage that SLLC is taking or the group is taking by doing this particular arrangement. So in this case, the interest paid by WLLC cannot be allowed or shown as a deductible expenditure for corporate tax purpose. Whereas in illustration 2, everything else is same, but for this tax rate in the case of SLLC is 9% instead of 5%. So here there is no difference in the tax rates, and both the companies paying tax at 9%. And though the funds that are taken by the WLLC are used for dividend payment and capital contribution, since there is no tax advantage by way of in this arrangement, so it can still be shown as expenditure, whatever interest paid by WLLC to SLLC, and can be shown as deductible amount. So this is how we just need to look at this. So now let's look at some of the practical considerations with respect to this thin capitalization, mainly within UAE. As you know, we do not have, we were not having corporate tax earlier, and we're not used to look at this. How much should be a capital amount? How much should be a loan amount? And how are you going to handle these interest amounts and all those? As long as interest is paid or payable, then you are accounting it as interest expenditure and then goes in the books. Now let's look at various challenges that we have in UAE. So when we look at what constitute optimal debt equity ratio from UAE. So obviously, so as I mentioned in my initial slides, there's no standard debt equity ratio that you can follow or you have to follow in UAE. You can have, for example, the total funds requirement of a company is about 10 million dirhams. You are allowed to have only 300,000 as equity and then balance amount of 9.7 million dirhams as debt or a loan. Whether it could be from third parties or could be from your shareholder. No one was questioning or objecting for this. But now we need to look at this, because once you've taken or once you've shown some amount as loan, obviously you are going to pay some interest amount on that. So will you be paying, will you be allowed the total amount of interest that you paid on 9.7 million as deductible amount for corporate tax purpose or not is what we need to look at. Obviously, so when you have to start your business, 10 million dirhams is what is required to establish a business or start a business. It is assumed or expected that out of this 10 million dirhams, majority portion is being contributed as a capital by the shareholder. So as we have seen, if you have more amount of equity and less amount of loans, obviously the interest amount paid as company will be lesser amount and the taxable amount of profit will be higher and then tax will be higher. So the authority will be interested in looking at what is the right amount of capital and right amount of loans that you are allowed to take. Accordingly, your tax amount and interest amount will be proper. So we have a challenge of this, and not only this, no, so far we have been looking at shareholders being loans, giving loans to the companies and then charging or taking interest. And shareholders excess amount contributed in addition to this 300,000 or whatever is mentioned on the memorandum. That entire amount is considered as shareholders current account. In some cases we were charging interest, in some of the cases we were not charging interest. So now you need to look at this. So whatever amount excess given by the owner or shareholder to the company, should it be considered as a loan? And if you consider that as loan, do you have to compute interest on that? As we know, the interest earned by the individuals on the funds given, if that is not a business, is not subject to tax, whereas the interest paid by the companies on those loans is allowed as deductible. So this kind of challenges are there where the revenue leakage for the department is there. So obviously authority will be interested in looking at it. So far we do not have any clear norms around this equity amounts, loan amounts given by the shareholders and the relatives. So there are no norms, so we have to look at them. But at the same time, we also know that whatever payments that are made by the companies to the connected persons, which are shareholders, directors, officers and their relatives. So those payments need to be at arm's length or market rate. If at all, if you are okay to pay the interest amount, that interest rate followed, is it at arm's length or not, is what we need to look at. To some extent, it is addressed, but of course, what is the ratio of equity and debt, that is not clearly known. So that area is still a challenging area to look at. The second challenge is that for startups, as I mentioned in my previous slides, Startups may have less amount of profit initially, but whereas the investment or the funds requirement will be more initially, and whereby the interest amount paid, available amount will be higher. So if you look at that 30% EBITDA computation, the limit will be lower, but interest amount payable will be higher. So they will be at a disadvantaged position of having less amount deductible for computation of tax. So this is one challenging area that will have issue. And the other thing is a specifically interest earned. As I mentioned, the interest earned by the individuals is not subject to tax. If shareholders are giving in loans to the companies, and that is not subject to tax, of course. But whatever payments made by the company, the individuals to the owners, the interest should be at arm's length. So this is what we need to look at. So then the other challenge is that whether deemed loans taken from later parties, so interest payment on that, so will it be subject to that interest limitation or not? So that is something that we need to look at. It is also one of the challenging area to look at. Interest imputation on closing balances due to transitional rules. So we had loans earlier, and do we have grandfathering rules allowed in this or not? And with respect to the interest payment made on loans taken before we get into corporate tax regime or before 9th December 2022. So that interest imputation challenge is going to be there. Whether interest on account of breach of contract subject to interest reduction limitation or not is also another challenge. So you have a contract and breach of contract, if you have any interest to be paid on that. So that interest paid on that breach of contract, will it be subject to this deduction limitation or not is another challenge. In addition to that, we need to look at deferred tax asset and deferred tax liability computation with respect to interest, which is not allowed to be deducted if you exceed that limit of 30%. Then in that case, you need to compute that because you carry forward in this interest to the following years, whereas in your books of accounts, you must have taken the total amount of interest as expense and arrive to profit. Whereas for a corporate tax computation purpose, you're only taking amount which is deductible as interest expense, and the rest of the amount is carried over to the next following years. So whereby you have different tax calculations to be done. So these are the various practical challenges that we can look at, we need to look at. And going forward, of course, we may come across many other challenges also. So from here onwards, I invite Rishabh to take it over to look at the rest of the presentation. Rishabh,
thank you. And before I begin, I acknowledge the presence of Mr. Rajiv Veera. The man himself is already here, and Hemant sir, senior. So I'll move forward. So thank you, Balram sir, for a amazing take through the concept of thin capitalization internationally and what we have in UAE right now, along with certain illustrations. So what I am going to take care would be on these practical challenges, what have been elucidated in the previous slide, and how these are going to work, and I'll touch a little bit upon the key points that were clarified in the ministerial decision 126. That is also part of the general interest deduction limitation. So I think we have another 12 or 15 minutes. So that is what I would like to do. And I request all the participants to put their questions in the chat box. So those can be addressed in the last 10 minutes. And yeah, I'll show up on this illustration regarding the interest deduction limitation, the carry forward, and how it has been done along with the ministerial decision 126 of 2023. So year one, so this is the first tax period. There's a company in UAE which has its EBITDA at 100 dirhams, interest income of 30, interest exempt income of 20, interest expenditure of 70, and a specific interest expenditure of 10. So Article 31, interest expenditure is 10, and Article 30, interest expenditure is 70, along with an interest income of 30. So moving ahead, in terms of calculation, how we'll do is that we'll see our EBITDA, but the law states that this EBITDA should be the adjusted EBITDA, wherein adjusted EBITDA does not include exempt income. So that's what we have done, 100 minus 20. So we have an EBITDA of 80. The maximum allowable interest in our case is 30% of 80, that is 24. However, we have a net interest expenditure of 40 dirhams, that is general interest expenditure of 70 less the interest income of 30. Uh, so maximum allowed is 24. So we have a 16 dirham interest carry forward that will go into the next tax period with the taxpayer. And that specific interest expenditure of 10 is completely disallowed. It's just that you need to determine as per Article 31 whether it is a specific interest expenditure, whether it falls under the conditions of the specific interest deduction limitation. As you have seen, loan from related party has been used for a particular purpose, and there is a direct corporate tax benefit. Going on to year two. So the year two numbers look something like this, wherein we have an interest income of 40, EBITDA of 130, exempt income of 25, general interest expenditure of 60, and a specific interest expenditure of 5. So we go through the same process, calculating the adjusted EBITDA over here. That turns around to be 105 dirhams, 130 minus 25. Then again, the 30%, that is maximum allowable uh, interest that can be deducted is 31.5. However, we have a net interest expenditure of 36. Very simple math on how we arrived at 36. So 60, what we had this year, and reducing the interest income of 40, and the 16 from the carry forward. So 36 is the total interest expenditure that is available for deduction, but we can unfortunately deduct only 31.5. So this remaining 4.5 will be carried forward. We have seen that these, the non-deductible interest expenditure is carried forward for a period of 10 years. But the law says that you need to carry forward the previous one. So over here, this 4.5, what is being carried forward, it will be carried forward for the 9 years, remaining 9 years, because it is out of the 16 that was carried forward into tax period 2. So this is the key point over here. And about specific interest expenditure, we know that it will be completely disallowed. So the only moot point over here is to see that which interest we are carrying forward, which we are setting off. So by rule, we need to set off the current year's net interest expenditure first, and then look at the carried forward one, and that's how we need to proceed. Um, one thing I would like to point out here more is on how this thin capitalization or interest deduction works internationally. And when I say internationally, we'll see, of course, a couple of jurisdictions. So one of being our nation close to our heart, India. So the difference, what we see between the Indian regime and the UAE regime, is that we are taking maximum deduction of 30% of EBITDA, but what is deductible is the net interest expenditure. So your complete interest expenditure reduced by your interest income. The Indian law talks about only the interest expenditure made to related parties, because interest expenditure made to third parties, they consider it as on arm's length and not as a tool for base erosion and profit shifting. So on the other hand, if you go towards the European nations, so France is one nation wherein this interest deduction limitation rule, uh, it is again, the limit is same, 30% of EBITDA, but what is deductible is the complete gross interest expenditure. So when we see the complete gross interest expenditure, so you're not getting any exemption for third party interest. B, you're not getting any reduction of interest income. So it is a gross interest expenditure that is seen in France. So just to give a little perspective on how the other countries are looking towards it, and
नहीं
UAE
नहीं
has kept
पूरा नहीं साफ करने बस हो गया
Janak bhai. So uh, yes, so overall, UAE has kept a little narrower scope, but wide enough to cover a lot of things. How we'll see, because the definition of interest or what interest is in itself is very broad. So we'll see that. Before that, we'll just one small illustration on one of the practical challenges was on shareholder loans. So here we can see the shareholder has given a 50,000 dirham loan at a 5% interest rate. Calculating of 2,500 dirhams of interest has been paid to shareholders. It is again very simple math to see that XYZ LLC, which is a taxable person, will take this deduction of 2,500 from its taxable profits. So saving about 9% on 2,500. And the shareholders or the natural person per se is not paying, or if it's not a taxable person, will not pay tax on such uh, interest income received. So it's kind of a double benefit. You took a deduction when you didn't pay tax. So it's not tax neutral at all. And this is something which actually worries me in the UAE market, that how it needs to work, whether shareholders can charge interest, but then we have interplay of transfer pricing, which says that all your related party transactions needs to be on arm's length. So there will be some interesting times ahead when we move, deeper into corporate tax regime in the UAE. Coming on to my previous point on, why the interest deduction limitation regime in UAE is very broad is because of the coverage of what is interest. The whole slide that you see here, all the pointers are things or the components which are included as interest. Even, they have not left any instrument to be covered here. So looking on from, performing, non-performing debt instruments, collective investment schemes, asset-backed securities, sale and repurchase, sale and lease back, securitization of assets, hire purchase agreements. So wherever you see an element of finance cost has been covered, even like things like factoring of receivables. So even such small nitty-gritties have been already covered by this ministerial decision. It went one step ahead, saying that, okay, if you have any given guarantee fees, arranger fees, or any commitment fees, or any other expense to raise finance, that also we will consider as interest for that particular year. So will be included in your, the overall calculation of net interest expenditure. Again, going one more step ahead, they said, okay, this was the primary instrument. If you have taken any secondary instrument to hedge the risk of the primary one, so you have taken a loan, and to hedge that loan, you have entered into another financial arrangement. And if you are having any interest or finance cost component in that, even that is covered, under the definition of interest for the calculation of net interest expenditure as per this ministerial decision number 126 of 2023. There was a very big question earlier before this decision that whether the Islamic financial instruments would be covered. The answer to it was given in affirmative, that yes, the interest component on those Islamic financial instruments will be duly covered for this interest deduction limitation calculation. And finally, I would say a little surprising on those lines that the finance elements of both the finance and the non-finance lease have also been covered here. So we know when we are creating a right of use assets or an intangible, wherein we had to, amortize it over the period of its useful life, and there's always a component of finance cost during the unwinding. That component is also covered as one of the parts of interest for the calculation of interest deduction limitation. Again, this key question, which was touched upon by Balram sir over here, is whether the shareholder current accounts are debt or equity. We consider them as running accounts. We do not, in most of the cases, do not charge interest. The shareholders do not charge interest. So, what is the nature of that shareholder's current account? This is something peculiar to UAE and is not seen in a lot of jurisdictions. So, you can put in the chat box your comments on what do you think, whether the shareholder current account is debt or equity, and if it is, we have got one answer. Okay, current account is equity as it is perpetual and no repayment terms. So there are again, why the confusion is because there are again arguments for both of them. That if there is no repayment, so again it has only one category of or one characteristics of equity, whereas other things might be seen as debt. So I keep this mood question for your food of thought before we end. And I just have one more thing to look at on is the de minimis rule that has been given in the ministerial decision 126, was also told by Balram sir in his initial slides, but I'll just quickly touch upon it. So if your interest expenditure does not exceed 12 million, all of it would be allowed, subject again to transfer pricing. So let us say you have an intragroup loan and you are well under the limit of 30% of EBITDA and let's say 12 million. So your total interest payment was 8 million to your related party. but your interest rate on that financial arrangement turns out to be 14%. But when you went to do the benchmarking for that related party loan, your arm's length interest rate came out to be 8%. So you escaped the general interest deduction limitation. Yeah. So you escaped the general interest deduction limitation by being within the ranges specified, but you were caught by transfer pricing. So there is a very big interplay for intra-group financing arrangements for transfer with transfer pricing and Article 30 and 34. So we need to see both the things are satisfied, even though you are allowed to get a deduction as per Article 30 because you're well within the limits, but transfer pricing provisions are there to limit that for you. An additional point, or two more important points that were there in Ministerial Decision 126 was the calculation of EBITDA. So it says you calculate your taxable income as per Article 20. So starting with accounting profits, making all the adjustments that you have to make, add back the net interest expenditure, add back the depreciation and amortization, as the definition says, earnings before interest, tax, depreciation, and amortization. And we also add back the interest cost or income of the historical financial instruments. So when we say historical financial instruments, so these are those arrangements which were made before the corporate tax law came into force, that is 9th December 2022. So let us say you have a loan agreement that was signed on 5th May 2022. The interest paid on that loan is not covered for this calculation. So you will not include it within the calculation of net interest expenditure as well as EBITDA. So this had to be these interest payments have to be grandfathered, and I would say not such an important point, but of course, for tax groups, if your subsidiary is joining a tax group or exiting a tax group, the net interest expenditure which has been carried forward is allowed to be adjusted only with its own income, that is income attributable to the subsidiary based on, again, on transfer pricing. So the crux of it, or the bottom line is that transfer pricing is also going to have a very significant influence over your financial arrangements, at least with the related parties. So you need to look at the specific rule for interest deduction, but you need to be aware of the bigger picture in terms of transfer pricing rules as well, and arm's length principle. With this small key takeaways, or important points that we've learned or we got to know is the interest limitation that is there. So 30% of EBITDA. It does not include exempt income. The taxpayers which are exempt are banks, insurance providers, and natural persons. The carry forward is available for 10 years. And of course, we have a specific article or a particular article for specific interest deduction limitation. With this, I officially conclude the presentation.